And as always, we're going to be looking for accurate context, good risk management, and always exercising good patience.
Everybody who's traded has gone through periods of time where their strategy hasn't worked.
Where if not a hard stop, you should reevaluate the trades you're in based on time.
That's what we're here for, is to put ourselves in the best success. A trading routine does that, builds that habit, lets you know what to work on, what to reflect on, and what to improve on the next day.
Hello, everybody out there. Welcome to Coach's Playbook for Tuesday, November 15th. I'm joined by Hogue, Mick, and Dan, the OG crew here for the Coach's Playbook to discuss a fun topic today. We're going to be talking about trading the news, and honestly, more so why you probably shouldn't be doing that. But before we get to that, Mick, you have a shout out for us. Somebody's up some hundreds.
I do. Some hundreds. Yeah, about 39 of them. Big shout out to Sabur Bashar, up 3,900, trading the NASDAQ or S&Ps, excuse me. I'm so accustomed to saying the NASDAQ. Someone's in the spoos today.
I am glad to see that. I wish we had more people in the spoos, to be honest. It just warms my heart as we get into the holiday season to see our friend trading the more liquid, less whippy ES contract. But I get off topic there. So
I'm there
anyway,
with you.
Yeah. So one of our contributors recently put out a blog that was talking about, I think, 13 surefire ways to be throwing away money. And one of them caught my eye because I didn't think we had talked about it. And it was specifically how traders tend to really underperform when they start trading news. And with that, I get why you feel like you want to do that, because I think in the media, I think that if you grow up looking at trading things, how traders always work is that they get some piece of news and they have the one contrarian belief that is right and everyone else is wrong. And then they make $1 billion, whether it's The Big Short or Margin Call or any of those films, right? But in reality, a human being trading outright futures into year 2022, it is going to be difficult for you to digest the news and respond properly to it with the information that you have. Hogue, you've seen the industry change along these ends from when things developed much slower to now with all these tapering algos and things like that are parsing tweets or whatever else.
Mm-hmm.
What's your feelings on trading news and whether it's a sustainable strategy to have in your back pocket?
Well, I've been around for a while, and I don't hold positions into known news or economic releases. And here's why. I've had some wildly successful days doing that, and I've had some absolutely horrible days doing that. If I total everything together over all the years, I'm about even. So I have the ability to make the choice not to participate in those. I would probably have a lot more hair and a lot less gray had I not held positions into major economic releases. Because if you've watched like CPI, the dome disappeared. There were prices that never got traded on that move. Even today with PPI, the dome disappeared, and there was a four point, whatever it was, 17 up to 25. So, we're looking at a 7-point move where nothing traded. If you have a stop, if you are trying to buy into something like that, there's nowhere for you to go. The algos all pull their orders, the HFTs all pull their orders, and then they respond after that. So if you're going to do it, you're going to be depending mostly, if not entirely, on luck of being the right direction. Because if you're wrong and we get into these vacuums like we did at CPI and then PPI today, you're going to be sustaining some pretty serious losses, according to the number of contracts you're trading. But it's Coin flip.
And if you're trading real live capital, say in a brokerage account, you're putting yourself at a lot of risk here. I mean, in Topstep or something, sure, you can blow out, but you're not required to pay what's below it.
Right.
I mean, if you're going to take something through CPI and it's going to be gapped out 15 ticks, you're essentially, as you said, flipping a coin. But then the second that fills in, you could be way below your maintenance margin, right?
Mhm.
I mean, and that's just makes it an extra degree of irresponsible stuff.
Yeah, I mean, these are leveraged markets. You do have the risk of losing more than you have in your account.
Look at Sam Bankman-Fried, right? I mean, dude had $14 billion like weeks ago.
Not
Now he doesn't
anymore.
Not anymore. These things, what do you say? Who was it that famously said that? Like, how do you go broke? At first very slowly and then all at once or something like that. These things can spiral out of control.
Mhm.
Now, there's two types of news trading. Hogue is referring to the known in advance news, which is that should be easy enough for you to avoid. You may feel some FOMO, but you know when that CPI number is coming out.
Mhm.
The other type of news trading, which I think, especially for beginner traders, is something that's attractive, maybe for the wrong reasons, is just digesting straight up news events, the stuff that's not planned, and then being like, well, this happened, so I think this is going to happen, so stocks should go down. And I think that that's a pretty dangerous thing to do as well. Mick, I know you traded a lot of commodities along the way, where there's all sorts of news that's both planned and unplanned that affects those markets. What's your kind of feeling on that? Will you just kind of pull out or cut your size or what?
Well, if you're going to be participating, cutting your size is certainly something you want to do. I want to break this up from, as far as trading into known releases. I'm not going to talk about the ones where you're seeing tweets about certain things around the world and whatnot. So fundamental news, it takes a while to play out in the markets. Fundamentals take a while to play out. Another thing that you want to think about too is losing my train of thought on the spot here. Are you day trading? I found it. Are you day trading this release that you know about? Are you putting something on new exposure ahead of the release? Or is this something that you've had on for a week or two now, where you might have, equity in the trade or whatnot, or you might have a much longer outlook than what unfolds in the 10 minutes, the 30 minutes, the rest of the afternoon after the release. So there's, if you're initiating new positions based off new information, much higher risk than if you have a little bit more of a time frame involved in the trade. So there's that to consider. It's trading the news, you may see a number that's bullish and the market breaks. You may see a number that's bearish and the market rallies. One thing people think about is, oh, there's all this new news out and everybody's reacting to it. I've thought about it this way before. This move is based off of new positions being initiated based off the news that happened. But the bigger participants out there are the institutional participants, and they may be reacting to the news and exiting positions that they've had on for a while. So, larger participants, they'll like to, they'll sell into strength. If I'm long and the markets, I get a favorable number, I'm going to be selling to offsetting or, making my position smaller and taking profits off the table. So they may love a bullish number and they may hammer that market, unloading some existing position that they already have. For the retail trader who's just jumping in, you're like, this is bullish news information. Why are we going lower? And it could be just because that the more aggressive sellers already had that long position and they're taking profits on it. And they're the ones that are moving the market lower. So you have to think about all the participants, all the different angles. And it's not just, hey, this news came out, everybody's dogpiling into new positions. I think that's a big piece that, newer traders don't think about.
The example that Dan and I talked to about on the podcast last week is, say, the upcoming unemployment number. I think we can all understand that it's better to have low unemployment than it is to have high. But I am 90% sure that if we get a terrible employment number next month, stocks are going to fly to the upside. Because it's not always the first order thing. It's that low number would greatly affect the way people think about interest rates going forward. And that would probably could be wrong. It's the markets. You never know, you can't say anything with certainty, but that's an example of like good or bad news are relative terms. It's more of like, what is news compared to expectations is the name of the game. And with a lot of these things, before I kick it to Dan, is that outrights just aren't made for some of these things. If you're in these like a big news swings or something off that, that's more the domain of trading spreads or something hedged where you're saying, okay, something's way out of whack. I can take a little bit of heat to see if it comes back, as opposed to just, I'm going to trade an outright security and just hope it goes higher or lower or something like that. Dan, welcome to the game. What's up?
Back to last in the order here. I see how it is. You gave
I
me
tried
my
my
chance
best.
last week. I think there's a lot of things to talk about in news. I will be very blunt and forthright in saying I have done a lot of news trading, but it's not with the outrights. Outrights are not, like Jack said, not something you want to be getting or dabbling into news. I mean, as options side of things, which is where my background is, you make your money on volatility. Volatility increases when unexpected news happens. Like those are opportunities for, profits to be made, but you're hedged, you're covered. You have a way to make money, whether the market goes higher or lower. You can rotate positions. I think at the end of the day, a couple of things you need to keep in mind, whether it's expected news or more importantly, the unexpected news. You can make a plan around what's going to happen during a CPI number, an unemployment number. I believe if this number comes out like this is what the market's going to do. Jack, just like you talked about with the unemployment number, right? Like we can have at least some sort of framework of a plan, but when it's an unexpected news event happening that's impacting these markets, there's millions of examples out there. If that happens, what's your plan, right? We always have to fall back onto, I have a strategy and a plan put in place that I've developed over months, years, decades of trading. And if it's unexpected, where does that fit in the plan? I think number one thing you have to think about is stop whatever I'm doing, because if I'm in a trade, I had a plan, market state has changed, the impacts on what's going on in the market has completely changed, back off. Hey, something happened here. This was not what I was looking for this market to do. I need to get out. Right. That's one of the big cues when you are entering into a trade. The only reason to get out of that trade is if the state has changed, if new information has hit the marketplace to tell you this was not why you got in the trade. So get out. Yeah. Now, if you see the market start moving and bouncing and happening because you got a news update, right? You get a notification on your phone from Wall Street Journal that, this OPEC came out and made a surprise decision on, looks like we lost Mick there, on, the oil market. And, you're going to try and go trade the oil market. Well, you don't know what's exactly going to happen. So then you start chasing. And number one thing on anyone's trading plan is not to chase. Don't get caught chasing a market. So you want to be away from that. Wait for the information to settle. I think Mick kind of touched on it pretty well. Like it takes a little bit for the markets to actually digest. And I've said this for years. There are two things that happen when an event happens, whether it's a planned release or an unexpected news event. There's going to be the emotion. The emotion is what John's talking about, HFTs and algos shutting down, the computers saying, hey, something happened, a guy flipping the switch. I've been there. I used to work with a team of traders that we were working on some algos, and that we would shut them off when weird events happened because it would impact the system, which would then impact the P&Ls. Once that quick volatility or that emotion, which most of that is just peeling things off, people getting away from it. Retail traders like to chase it because it's exciting. There's fast movement, quick money to be made. And that's really the stuff you want to stay away from. Once you see that emotion start to slow down, then there's the actual reaction to the information that was released. And that's where you start to see people, okay, now I can start getting in. Liquidity has thickened back up. We're getting a little bit more decision or clarity on the direction. We're finding good levels that are, actually starting to hold or create some support or some sort of resistance. I can now trade at this point. That's what you really want to look for. You got to find that confirmation that the market's going to give you an opportunity. It's great to catch a big winner because you saw some momentum. I get it. I have chased. I've seen the markets move. I have jumped in. I know I shouldn't have. Sometimes it's worked great. A lot of times it hasn't. And that's just strictly because there's no planning around that trade that you're taking. If you can see what's happening, you can let it slow down. You got to think about where's my risk and cutting that risk down. If you've got $2,000, $4,000, $8,000 in account on these fast moving news impacts, when the market is ripping, like John's talking about, the dome's disappearing and you're chasing, imagine how quickly you can lose 20%, 40%, 50%, or 100% of your account balance on one number. Is it really worth it? I don't think so.
No. No, that is why I kept it around. I've talked about before. I used to have my doomsday button on the old auto spreader. It was like the clerks had to stay away from it. It was basically a button that if I hit it, it was just going to toss my entire risk allocation into a long 5-year treasury futures. So take from that what you will. Never got to use it, thankfully. That's something you don't want to have to use.
Not the doomsday switch.
Not the doomsday switch. Yeah.
One other point I want to make is, we've seen big moves recently off the CPI, the PPI, the FOMC statement. Like a number of these moves, we've seen a violent move in one direction, over the course of, the next 5-10 minutes, hour, or something like that. And then the remainder of the session, we go scream in the opposite way too. So just another thing to remind yourself of, you could be right. You could be in the money big time if you catch the right side of that initial move. But then, there's the head fake and then it goes screaming, 4 times in the other direction too.
Absolutely. I would argue this was the one I was more confident in, the CPI this month. And I have the ticket somewhere from past episodes of this, is the cool CPI number is the number that I definitely would not fade in long ES. I know it's tempting when it's up, whatever it was, 500, 600 points, but it closed 800 up in the NASDAQ. I mean, that's what everyone's been waiting for. So I would not, in future CPI numbers, if they come in low, don't get in that way. Don't get in the way of that train. Similarly, if they come in high, I feel like that's I talked about how it could be good or bad news, say a bad unemployment number. That CPI number, as far as what the initial move is going to be, is pretty set in stone. If that comes in hot, stocks are getting crushed. If it comes in cool, to the moon we go for at least another few days. So that's my thought there. Anyone have any other great insights before we kick it over to a quote and get on to lunch?
Well, I think Dan really put his finger on a major part of it is, how are you going to manage your risk in these situations? Do you have specific risk that you're going to be able to adhere to in these situations? Most of the time you don't. And as as Mick was saying, quite often it's buy the rumor and sell the news.
Right. You always want your risk to be defined somewhat. The same way we talked about when those limits were getting hit. The reason we don't allow traders in the combine or funded account to have positions on when we're between, 1% of the down breaker, 2%.
Within 2%
the reason being,
of a price limit.
So it can close that limit very quickly. And once you're stuck there, man, if you're on the buy side of that sort of limit, that you are so screwed. I get, go back. I'm sure there's videos online. When we were hitting those things during COVID, it wasn't like people let up then. There would just be thousands of contracts sitting on that offer, waiting to just rip it again down.
And on a couple occasions during that sell-off in COVID, we were locked limit down with thousands and thousands and tens of thousands of contracts on that lower
offer
price band.
Mm-hmm.
And then we open up, and within about a second or two of reopening, we're locked limit down at the next price limit.
We can talk strategy about that stuff sometime, but the easiest strategy is just don't be in that situation. I think you'd have to look, if somehow you did get stuck there, I think you'd have to look at trying to sell some whatever you could in the other indices if they weren't locked yet. But
at the end of the day, I mean, there's good opportunity. There's maybe good money to be made in those instances. But again, it goes back to how much, what are you willing to risk to get in on that move? maybe the people that are able to get in those trades have a couple $100,000 sitting in their account and they're okay risking 50, 60, 70,000. But these are big timers that are coming with big money. These, standard retail trader, say you got 20 grand in your account or 30 grand, or there's a great story about a crude oil trader at Interactive Brokers when crude oil went negative. And they couldn't get in. He had $70,000 in his account. He worked really hard for it, but he got caught in that position. He was long at 1 penny on crude oil because Interactive Broker wasn't allowing the dome to go negative. He woke up and he was in the hole $1 million. I mean, you got to think about these things, what really can happen. This isn't like buying a stock where if you bought a stock at $20 and it goes down to zero, you lost your $20 and you're done. You can lose like John said, you can lose a heck of a lot more than you put in. And it's
the good news
not
in
worth
their defense. I believe Interactive Brokers did make that guy whole on that.
They did. There were a number of traders that were in. I think it cost them tens of millions of dollars. But they made everyone whole.
I want to say like 80 million it cost them, that's some money.
That's a lot of money. And they did the right thing. But it's that concept. You think you're in a good price.
Mm-hmm.
The market can just keep going.
Got to use common sense.
I think that was the first time we all saw that. I think that May contract of 2020 and the crude oil went down to 33 or minus 33, $34 a barrel. And who would have known you could have gotten paid, all that money to just take a physical commodity that actually had some value, but didn't have value technically because there was nowhere to keep it.
No, and often if something does look too good to be true, I think you just need to know it. Like if people are selling oil contracts for 1 cent, they are not doing so out of the goodness of their heart. Right. So just something to keep in mind. Use some of that negative oil now, that's for sure.
Yeah.
Wouldn't mind.
All right, Dan, you got a quote for us before we
I
get
do.
off?
In regards to talking about news, I like this one. Time is your friend. Impulse is your enemy.
That is very good. Well,
I like
it's snowing and the babysitter is back with my son in the snow. So I got to sign off right now. It's an important one. I will see y'all later. Have a great week, everybody. Trade well. See you soon.
See you later.
Take care.